Save, Invest, Grow. In India, an initial public offering, IPO, is a process through which a private company offers its shares to the public for the first time, allowing the company to raise funds from investors. The IPO process in India is regulated by the Securities and Exchange Board of India, SEBI, which is the country's securities market regulator. Here's an overview of how the IPO process works in India. Preparation and SEBI approval. The company decides to go public and appoints an investment bank or merchant banker as the lead manager for the IPO. The lead manager helps the company prepare the necessary documents and submits them to SEBI for approval. These documents include the draft Red Herring Prospectus, DRHP, which provides information about the company, its financials, operations, management, and risks. Roadshow and investor outreach. Once SEBI approves the DRHP, the company, along with its lead manager, conducts a roadshow to generate interest and awareness among potential investors. This involves presentations and meetings with institutional investors, analysts, and other stakeholders. Pricing and allotment. Based on the feedback received during the roadshow, the company and its lead manager determine the issue price of the shares. The final offer price is mentioned in the Red Herring Prospectus, RHP, which is the DRHP with the offer price filled in. Shares are then allotted to retail and institutional investors based on their bids and the available shares. Listing and trading. After the allotment process, the shares are listed on one or more stock exchanges in India, such as the Bombay Stock Exchange, BSE, or the National Stock Exchange, NSE. Trading in the shares begins on the listing day. Lock-in period. In India, there are certain regulations related to a lock-in period for promoters and other major shareholders. These individuals are restricted from selling their shares for a certain period of time after the IPO to maintain stability in the stock's price and prevent excessive selling pressure. Post-IPO compliance. After the IPO, the company is required to adhere to regular financial reporting and disclosure obligations as mandated by SEBI. This includes publishing quarterly and annual financial results and other relevant information to keep investors informed. Book building process. Many IPOs in India use a book building process to determine the issue price. In this process, the company and its lead manager invite bids from investors in a specified price range. The final issue price is then determined based on the bids received. Green shoe option. Some IPOs include a green shoe option, also known as an over-allotment option, which allows the lead manager to sell additional shares if there is strong demand. This helps stabilize the stock price in case of significant price fluctuations after listing. IPOs in India have gained significant attention in recent years due to the growth of the Indian economy and the increased interest of both retail and institutional investors. Companies from various sectors, including technology, finance, manufacturing, and more, have gone public through the IPO route to raise funds and expand their operations.